Good morning, hunters. Welcome back to the Daily Hunt from Multibaggers on this Tuesday, November 4th, 2025. We've got a lot to chew on today from yesterday's social media deep dive.
That's right, Ethan. Our AI churned through quite a few posts, flagging numerous stocks, and the sentiment, well, it's a real mixed bag out there. Some strong bullish vibes for the big tech players, but also some serious red flags and concerns about high valuations, as you'd expect.
Definitely a truly dynamic day of commentary to unpack, with a mix of exciting growth narratives and, some very pointed skepticism. Let's jump right in.
All right, let's kick things off with Apple, AAPL. Our analysis gives it a slightly cautious outlook today. Previously, we've seen it swing between stay away and buy.
Well, there's still a lot to like with Apple. We're seeing Vision Pro making serious inroads into major sports like Real Madrid and the NBA. That suggests, significant new market opportunities and revenue streams. And one analyst just raised their price target to $270, which is a good sign. Their financial health, with a net profit margin of nearly 27% and an ROE of over 171%, really underpins that optimism.
Ethan, I hear you, but the numbers tell a story that needs caution. That PE ratio is still sitting at a high 36.11, and at 269.05, it's already very close to its 52-week high of 277. That doesn't leave much room for immediate upside, does it? Plus, there are questions around the sustainability of this uptrend, and frankly, a lack of clarity on their AI strategy. Let's not forget Warren Buffett's Berkshire Hathaway quietly trimmed a $6 billion stake. That's a big institutional investor showing some prudence. For new positions, despite the Vision Pro's potential, my take is stay away.
Fair points, Brooke. Next up, AMC Entertainment Holdings. The sentiment is pretty clear here.
Bearish is almost an understatement, Ethan. User complaints are overwhelmingly negative, with many reporting massive losses, sometimes 95%. It's often labeled a pump and dump or a terrible stock. The current price of $2.58 is barely above its 52-week low. Fundamentally, it's losing money hand over fist, with a negative net profit margin and EPS. And a negative price-to-book ratio is a glaring red flag. Even with some hopeful whispers about upcoming earnings, there's just no justifying those KPIs. It's a clear stay away. We've had it as a stay away before, and that hasn't changed.
Moving on to a different beast, Microsoft, MSFT. Our analysis gives it a strong bullish lean today, maintaining its buy rating. Now, this is where the growth story really shines, Brooke. Microsoft just inked a massive $9.7 billion deal with IREN, and they're pouring $15 billion into expanding AI and cloud infrastructure in the UAE. That's serious strategic expansion. Their revenue growth is excellent at 18.4% for a company its size, and their net profit margin is an impressive 35.7%. Analysts are still raising price targets, seeing Microsoft at the intersection of software and AI. The future for them, it seems, is incredibly bright.
I'll concede, Ethan. Microsoft's fundamentals are robust, and those new deals are certainly impressive. However, the stock's PE of 36.77 is high, reflecting a lot of future expectations already priced in. While its operational efficiency is stellar, a stock trading so close to its 52-week high, 517 versus 555, means any new investor needs to be mindful of a potentially limited upside. Still, the growth drivers are powerful. My verdict is buy. It seems to be holding strong in that category.
Next, let's talk Hims and Hers Health, HIMS. This one generated some very polarized discussions. Some of the users were quite bullish, with YOLO investments and predictions of 20% gains after hours. There's a belief in the easy money aspect of their business model, and technical analysis suggests a super mega bounce could be coming. Plus, their revenue growth is a stellar 72.6%, and they're negotiating a new deal with Novo Nordisk for an obesity pill, which is a huge market, for future growth.
But Ethan, the user sentiment is actually leaning cautiously bearish, with a lot of skepticism that the exponential growth is done. Users are worried about market saturation, increased competition, and even product differentiation issues. And let's look at the numbers. That PE is a sky-high 56.19. Coupled with a very high debt-to-equity ratio of 185.604, this company demands near-perfect sustained growth to justify its valuation. The stock is significantly off its 52-week high, indicating a lack of sustained confidence. For me, that's a definite stay away. It was a stay away last week, and those risks are still prominent.
All right, let's move to Kimberly-Clark, KIMB, a new name on our list today, following their acquisition of Kenvue.
This is a tough one, Ethan. While the initial post was bullish, the user and market reaction has been overwhelmingly bearish. KMB stock nosedived to its 52-week low right after announcing the Kenvue acquisition. The debt-to-equity ratio is an astonishing 500.068. That is a massive debt burden, and users are raising concerns about potential litigation from Kenvue and whether KMB can even integrate these new brands effectively, drawing parallels to Kraft Heinz's struggles. Organic revenue growth for KMB is practically flat. This just screams risk. It's a clear stay away.
Okay, let's turn our attention to NVIDIA, NVDA. This one always ignites passionate debate, and today is no different. We've seen it bounce around in all categories recently. You know, despite some of the noise, NVIDIA's growth narrative is still incredibly powerful. Investors are taking profits, but still holding, which shows continued confidence. We're talking 55.6% revenue growth, a net profit margin over 52%, and an ROE over 109%. Analysts are still raising price targets to $240, $350, even talk of a $10 trillion valuation. Users are largely dismissing Michael Burry's bearish bet, saying he's too early. The demand for their AI hardware is just not slowing down.
Ethan, I agree the fundamentals are strong, but the valuation is, well, it's just eye-watering. A PE of 58.77, and it's trading practically at its 52-week high. That means any new entry is buying into peak exuberance with very little margin for error. And let's not ignore the beta of 2.12. That signifies extreme volatility. If the AI hype narrative stumbles, or if there's a broader market correction, NVDA could see amplified losses. One analyst called their price-sales ratio a big number, hinting at overvaluation. For new positions, the risk-reward balance right now is simply too skewed for me. My call is stay away.
All right, next up, Advanced Micro Devices, AMD, another semiconductor giant also prone to intense market scrutiny. User sentiment is leaning bearish on AMD, Ethan. Many feel the stock, which is up almost 20% this month, is already priced in. They're worried about a potential market peak and historical underperformance post-earnings. The PE is an astonishing 156.41, and it's trading near its 52-week high. Their net profit margin is less than 10%, which doesn't justify that PE. And a debt-to-equity of 6.513 is quite high. They'd need an absolutely stunning earnings beat and guidance to even begin to justify these metrics, and frankly, the market is skeptical. It's a stay away. It has been a stay away recently, and for good reason. Okay, let's pivot to Alphabet, GOOG. This tech titan is showing some strong bullish signals. It's consistently been a buy for us recently.
Brooke, Google is firing on all cylinders. They're partnering with Magic Leap for AR glasses, pushing into new frontiers. We've seen reports of a $100 billion quarter, and analysts saying it's not too late to buy as growth accelerates. They're financing AI with debt, which is actually seen as bullish, and they own the entire AI stack: talent, models, chips, data centers. That strong data advantage and their track record of resilience during market downturns, makes a very compelling long-term case.
Ethan, I certainly can't argue with Google's formidable position in AI and their impressive revenue growth of 15.9%. The PE of 28.02 is attractive compared to some of its peers, even slightly below the S&P 500's average. But it's also trading very close to its 52-week high of 291.93. While the long-term prospects are fantastic, new investors need to manage their expectations for immediate explosive gains at these levels. However, given the strong fundamentals and growth catalysts, I agree, it's a buy.
Now for Antero Resources. AR not related to ARVR, so we're relying on the financial data alone today.
Correct, Ethan. And the financial data for Antero Resources is a mixed bag, leaning cautious. While they swung to a Q3 profit and revenue is up 13.4, which is good, the debt-to-equity ratio is an astronomical 47.492. That's a huge red flag and poses significant financial risk, especially in a volatile sector like energy. The stock is also closer to its 52-week low than its high. While Wells Fargo did upgrade it, the debt profile is too alarming for me. It's a stay away. That's a consistent rating for this one.
Let's talk about Tesla, TSLA. Always a crowd favorite, this one has been a stay away for us recently. But the community is often bullish. You know, users are incredibly bullish on Tesla, largely dismissing any bearish put trades. They believe TSL defies all odds and is heading for ATH breakout levels. Elon Musk's upcoming pay package vote, which Wedbush expects to pass overwhelmingly, is seen as a huge catalyst. And let's not forget that massive $2.1 billion battery deal with Samsung SDI. That's a huge expansion beyond just vehicles, promising significant future revenue. The hype factor, with predicted flying roadsters and FSD updates, continue to drive sentiment.
Ethan, the hype is undeniable, and the stock's performance this year, a 93% rally, certainly reflects that. But we have to look at the numbers. The P/E ratio is an astronomical 323. That's a valuation priced for absolute perfection and then some. It's trading practically at its 52-week high, which means, again, limited immediate upside for new money. And a debt-to-equity ratio of 17.082, while not as high as some, is still a point of caution for a company already valued so richly on future potential. While I acknowledge the impressive growth initiatives, the valuation risk at these levels is too high. My verdict for new positions is stay away.
Moving to Meta Platforms, this one has seen a bit of volatility lately, but the core business seems strong. It was a cautious buy yesterday. Brooke, Meta's Q3 results were strong, with a 26% year-over-year revenue increase. Their Meta Ray-Ban glasses are surprisingly popular, thanks to improved AI features. And they're strategically pivoting their super intelligence lab to focus even more on AI and broaden VR beyond gaming. This shows strong execution and a clear path for future growth, building on their core strengths. The company is actively investing in the future, which is something I always look for.
I agree there's a lot of underlying strength, Ethan. Revenue growth is a robust 26.2%, which is fantastic. However, the stock has experienced an 8.8% drop this month, and while that might look like a dip, it also signals market caution. The P/E of 28.25 is still demanding. There are also headlines about an AI product problem and increased spending weighing on shares. So while the long-term vision is compelling and the recent dip might be an opportunity, new money should proceed with awareness of the ongoing investments and market uncertainty. I'm classifying it as a cautious buy.
Let's discuss IREN Limited, IREN. This company has made some eye-popping announcements recently. This has been a very volatile stock, often a stay away. Brooke, this is a game changer for IREN, a $9.7 billion AI cloud deal with Microsoft, plus a $5.8 billion supply agreement with Dell. That's a total of $8.5 billion in AI hosting contracts. This former Bitcoin miner is clearly pivoting into the high-growth AI infrastructure market. Users are calling it a metamorphosis and saying it's just the tip of the iceberg, giving their 3-gigawatt power pipeline. The stock literally soared 27% pre-market on this news. That's incredible growth potential.
I concede, Ethan, these deals are massive and transformative for IREN, and the revenue potential is certainly compelling. However, we're talking about an extremely high P/E ratio of 173.72, signaling immense future growth is already priced in. Historically, their revenue growth has been quite modest, and while these new deals will change that, execution is key. And let's not forget the beta of 4.199, indicating extreme volatility. This is a high-risk, high-reward play, and for most investors, it still warrants caution given their historical unprofitability and current lofty valuation, even with incredible future prospects. I'd lean towards cautious buy, but emphasize the cautious part strongly.
Up next is Beyond Meat, BYDN. This one was once a darling, but our insights have been consistently stay away.
And for good reason, Ethan. The financial health is frankly dire. We're looking at severe unprofitability with a negative net profit margin of over 50% and EPS of negative 2.14. Revenue growth is actually negative at negative 19.6, meaning their sales are shrinking. The stock has plummeted from nearly 8 to 139, and a delayed earnings report just caused another 16% tumble. There's just no fundamental case for investment here, despite any speculative roadmap. It's a definite stay away.
Right, and now for Palantir Technologies, PLTR. This one has given us very mixed signals, often stay away, but with flashes of buy. Palantir just crushed its Q3 earnings, Brooke, beating estimates with a remarkable 63% year-over-year revenue growth and an astounding 121% in U.S. commercial revenue. They've raised full-year guidance and partnered with NVIDIA for AI logistics. Wedbush even called it a major step in the right direction in AI revolution. The growth story is undeniable here, and some users still believe Palantir only goes up.
Ethan, while the growth numbers are impressive, the market's reaction and many user comments signal significant caution. We're looking at an eye-watering PE of 714 and a PB of 82.87. Users are calling it scary and idiotic, and many are taking profits, anticipating a sell the news reaction. Even with stellar results, a valuation this high leaves absolutely no room for error. The stock is trading at its 52-week high, and with a beta of 2.595, any minor disappointment or market shift could lead to a significant plunge. Michael Burry is even shorting it. My speculative analysis for new positions is a strong stay away.
Next up, Amazon, AMZen. This is another tech behemoth that often performs well, and today's analysis is looking good for it. Brooke, Amazon is a powerhouse, you know? Users believe their brand has the Midas touch, and its resilience, even after an AWS outage, shows incredible market confidence. And get this, AWS just secured a monumental $38 billion cloud deal with OpenAI, plus a $5.5 billion AI lease with Cipher Mining. That's huge for future revenue and solidifies their AI infrastructure leadership. Project Rainier is also signaling breakthroughs. Analysts and even billionaire investors are calling it one of the best stocks. It's got a healthy 13.4% revenue growth. That's a strong buy.
Ethan, I agree. Those AWS deals are indeed massive and very impactful for future revenue and margins. While the PE of 35.82 is on the higher side, Amazon has shown it can grow into its valuation. It is, however, trading very close to its 52-week high, so new investors need to be aware of the current premium. But given the clear catalyst for future growth in high-margin areas, I'm comfortable upgrading this to a buy today.
Let's talk about Snap Inc., SNAP. It's been a consistent stay away for us.
And it remains one, Ethan. Despite their innovations in AR, VR, and a partnership with Xbox, the financial picture is grim. Snap is deeply unprofitable, with negative net profit margins, EPS, and operating margins. Their debt-to-equity ratio is an alarming 202.575. The stock has been on a consistent downtrend, trading near its 52-week low. While future tech is exciting, current fundamentals just don't support an investment. It's a clear stay away.
Okay, let's look at Kenvue, KVUE. This stock is on our radar due to its acquisition by Kimberly-Clark. It was a stay away when we last mentioned it. This is an interesting one, Brooke. Kenvue has those unstoppable brands like Tylenol and Band-Aid, known for sticky cash flow. Kimberly-Clark saw the value, acquiring them for an implied price of around $18.42. Kenvue is currently trading at $16.14, which, presents a pretty decent arbitrage opportunity if that merger closes successfully. Citigroup even raised its price target to $18. It's a classic event-driven play with clear upside.
I agree on the arbitrage potential, Ethan, which is the main driver here. However, Kenvue's standalone revenue growth has been slightly negative, and it did report a $595 million one-off loss. While the deal looks promising, there are always risks with mergers, and KMB's own stock reacted negatively to the news. For investors, this is about the deal closing smoothly. Given those factors, I'd classify it as a cautious buy. It's an upgrade from its previous stay away purely due to that merger arbitrage.
Finally, Open Door Technologies, OPEN. This has been a very volatile stock and a consistent stay away for us.
And unfortunately, it remains a stay away, Ethan. The Post mentions steady accumulation, but our AI-generated insights tell a different story. Opendoor is deeply unprofitable across the board, with negative net profit margins, EPS, ROE, and ROA. Its debt-to-equity ratio is an extremely high 346.117, posing significant financial risk. While it has seen rapid surges in the past, implying high beta, that doesn't mitigate the fundamental unprofitability.
All right, that was quite the deep dive. Let's wrap up our morning hunt with a quick roundup for deeper analysis.
Indeed. For listeners looking to dig further, here's our compiled list for today.
Investigate as buy. Microsoft Corporation, Alphabet Inc., Amazon.com Inc. Investigate as cautious buy. Meta Platforms Inc., Kenvue Inc., Cipher Mining Inc. Investigate as speculative gamble. Tesla Corporation. And that's all the time we have for today's Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for joining us. We'll be back tomorrow with more AI-generated insights for your daily hunt. Happy trading, everyone.